Welcome back to Wall Street Podcast.
Good to be here.
Today we're digging into a new report from Bank of America. It's called the RIC report. Cash for now, but maybe not for long. Came out August 6th, 2025.
Right. And it really tackles this huge pile of cash U.S. households are sitting on. We're talking, significant amounts.
And the pressure that's building for that cash to move somewhere else. Looking at strategies around yield, quality, and maybe even stagflation.
Exactly. The starting point is pretty stark. U.S. households hold over $19 trillion in cash.
$19 trillion, wow.
Yeah, and that's more than 30% above where we were trending before COVID. Big jump.
Okay, but cash is safe, right? Isn't that the point?
Well, that's the catch. The report argues that once you factor in taxes and inflation, let's say you're in a 35% tax bracket and core PCE inflation is around 2.8%. Your actual return on cash in 2025 is likely negative. It's losing purchasing power.
So eroding value. Not so safe after all. And BofA thinks inflation will stay sticky this year.
That's their forecast, yes. Sticky inflation for 2025. They don't see U.S. rate cuts or lower yields really happening until 2026.
Which definitely pushes savers to look elsewhere, doesn't it? If cash isn't yielding anything real.
Precisely. It creates that incentive to rotate out. Now, on the macro side, BofA has a bit of an out-of-consensus view.
Oh, well, so?
They're predicting no Fed rate cuts at all in 2025.
None, even with global trends.
Right. They point to potential tariff impacts boosting inflation, plus a still strong labor market keeping the Fed on hold.
Interesting. Especially since we saw those two Fed governors dissent in July wanting cuts. First time in decades, wasn't it?
Over 2 decades, yes. So there's clearly some internal debate there. But BofA's official line is no cuts this year.
But globally, it's a different story. The BOE, ECB, China, SMB, they've all been easing over the past year.
A clear divergence, absolutely. And adding to the mix, while stock volatility has been kind of low.
Yeah, surprisingly calm.
Bond market volatility is still way up,
Sitting
significantly above pre-COVID levels. So navigating fixed income is tricky.
Okay, so that brings us to the pressures. What's really pushing investors out of cash right now, according to the report?
The number one thing is that negative real return we talked about. Take a T-bill yielding, say, 4.3%. For that 35% tax bracket investor with 2.8% core PCE inflation.
They're losing money in real terms.
Correct. Plus, there's uncertainty about future rates. The difference between a 2-year and a 10-year Treasury note is only about 40 basis points.
Not much incentive to lock in longer-term yields then.
Exactly. It makes holding all that excess cash feel riskier than people might think.
So if cash is risky, where does BofA see opportunities? Where might this money flow, especially if policy does eventually ease?
Well, they highlight a few key areas. Equity income is one. They mention things like the Vanguard International High-Dividend Yield ETF, VYMI. That's yielding over 5%.
Okay, decent yield.
Or the Invesco S&P 500 Enhanced Value ETF, SPVU, yielding about 2.5%. Also small and mid-caps, international value stocks.
Right. And gold, still the stagflation hedge.
Still a favored hedge, yes. And in credit, they point towards higher-yielding stuff. Think high-yield corporate bonds. Maybe via an ETF like ANGL, the Fallen Angel one, yielding around 6.5%.
Fallen angels?
Right.
Bonds that used to be investment grade.
Exactly. And also AAA-rated CLO ETFs. Collateralized loan obligations, you can get yields around 5.1% there, like with PAA. And underpinning a lot of this is the expectation of a weaker U.S. dollar.
Got it. Now, what about sectors? If short rates do fall faster than expected, how does that play out in equities? Large caps versus small caps, for instance.
Okay, so if rates drop significantly, but we avoid a major recession, consumer discretionary stocks could get a real boost, especially anything tied to auto loans.
Makes sense. Easier financing.
Yeah, and you might see money shift from short-term bonds into equity income strategies, too. Now, large-cap growth stocks, they're fairly resilient, strong balance sheets.
Like small and mid caps.
Much more rate-sensitive. Over 40% of their debt is short-term or floating rate. So if rates fall, they could see a sharp rally, at least short-term.
And risks. Any specific sectors flagged?
Real estate comes up as having the most refinancing risk. And they throw out a warning. If the 10-year Treasury yield were to climb towards 7%, well, that could really compress S&P 500 multiples, squeeze valuations.
Okay, bringing it back to the everyday person, what's the main takeaway for individual savers and investors?
I think the core message is that just parking large amounts of savings in cash right now could mean you're actively losing purchasing power. That lure of higher short-term yields we saw post-2022, It's fading, especially after inflation and taxes.
And don't expect mortgage rates to drop quickly just because the Fed might eventually cut short-term rates, right?
Exactly. Mortgages are tied more to the long end of the curve, which moves differently. Any relief there will likely be slow.
So thinking about all this, sticky inflation, uncertain rates, the idea of cash as a completely safe haven seems, well, less certain than it used to be.
It definitely requires a closer look.
Which leaves us with a final thought for you listening. How might this changing landscape prompt a rethink of your own personal financial strategy, moving beyond just the professional portfolio view? Something to consider.